You're scrolling Zillow. You find a house you actually like, 3 bedrooms, nice yard, good schools. You're feeling it. Then you look at the monthly payment, $3,200 a month. And just like that, your stomach drops. You're not bad with money. You've got a job, you've got credit, you've done everything right. But mortgage rates are sitting at 6.5% right now. And that turns a totally normal house into a payment you can't afford. So what do? You wait, you rent for another year and hope rates come down. You buy anyway and just eat it. Or you do what most people don't even know is possible. You find a home where you take over the seller's existing mortgage, their rate, their payment, 2.5%, 3%, locked in from back in 2020 when rates were basically free. That's an assumable mortgage. And yeah, it's real. I close these every single week. I'm Ryan Thompson, the Assumable guy. And in the next 10 minutes, I'm going to show you exactly how this works, what it costs, and how much money it could save you. Let's get into it. So an assumable mortgage is exactly what it sounds like. You assume or take over the seller's existing loan, their rate, their balance, their terms. Everything transfers into your name. You're not getting a new mortgage at today's rates. You're stepping into the one they already have. And the reason this matters right now is because millions of homeowners locked in rates between 2 and 3.5% back in 2020 and 2021. Those loans still exist. They didn't go anywhere. And by law, FHA and VA loans are assumable. Let me say that again because most people miss it. FHA loans and VA loans are assumable by law. That means if a seller has one of these loans, a qualified buyer can take it over. Conventional loans, the ones backed by Fannie Mae and Freddie Mac, are not assumable. So we're focused on FHA and VA here. And if you're wondering, no, you do not have to be a veteran to assume a VA loan. Anyone can do it as long as you qualify financially with the lender. Now let's talk about the math because this is where it gets really interesting. Let's say you're looking at a $400,000 home. At today's rate of 6.5% on a 30-year mortgage, your principal and interest payment would be about $2,528 a month. Now let's say that same home has an assumable FHA loan at 2.75% with a remaining balance of $350,000. Your principal and interest payment on that assumed loan would be about $1,429 a month. That's a difference of about $1,100 every single month for the remaining life of that loan. Run that out over 25 years and you're looking at total savings of over $300,000 compared to getting a new mortgage at today's rate. Same house, same neighborhood, same everything. Except one buyer is paying $1,100 less per month. That's the power of the rate, and that's why I say the rate is the asset. Okay, so now you're thinking, this sounds amazing. What's the catch? The main thing you need to understand is the equity gap. When you assume a mortgage, you're only taking over the remaining loan balance. You're not financing the full purchase price. So the difference between what the home sells for and what's left on the loan, that's the equity gap, and you need to cover it. Using that same example, home price is $400,000, loan balance is $350,000. Your equity gap is $50,000. That's the money you need to bring to the table. Now, $50,000 might sound like a lot, but think about it. On a regular purchase at 6.5%, you'd need a down payment anyway. FHA requires 3.5% down, which on a $400,000 home is $14,000. So yes, the equity gap is bigger, but you're saving over $1,100 a month, which means you earn that extra cash back in about 3 years through payment savings alone. And there are ways to cover the equity gap beyond just cash. You can use savings, obviously. You can use a gift from family. You can use a HELOC on another property if you own one. We work with lending partners who offer second loans specifically designed for covering the equity gap, and they only require 5% of the purchase price down. You can even use seller financing in some cases. There are options. So how does the actual process work? Let me walk you through it. Step 1, you find a property with an assumable mortgage, FHA or VA loan. I maintain a list of these across Colorado that I update every week, and I personally contact listing agents to confirm which properties are assumable and which VA sellers are willing to leave their entitlement with the property. That second part is a big deal, and I'll explain why in another video. Step 2, you figure out if the equity gap works for you. I send you the loan details. If the gap fits your budget, we move forward. If not, we move on to the next one. Step 3, we write an offer with the correct assumable clauses and deadlines built in to protect you. Step 4, you work with the current mortgage servicer to qualify for the assumption. This is similar to applying for a regular mortgage. They check your credit, income, and debt to income ratio. Step 5, We work with an assumption processor who pushes the deal through the servicer. This is a critical part. Servicers are slow, they don't have dedicated assumption departments, they don't make much money on these, so they drag their feet. Having a processor who knows how to push is the difference between closing and sitting in limbo for months. Step 6. The mortgage transfers into your name and you close. The seller gets released from the loan, you own the home. Done. Now, I want to be honest about the timeline. This process takes longer than a normal purchase. A typical mortgage closes in about 30 days. An assumption takes 45 to 90 days, sometimes longer depending on the servicer. It's not fast. It requires patience and some paperwork that can be a pain. But think about it this way. Would you spend an extra month or two on paperwork to save $1,100 a month for 25 years? That math answers itself. The other thing I want to address is why most people don't know about this. It's simple. Most agents have never done one. Most lenders would rather originate a new loan at 6.5% than process an assumption at 2.5%. There's no financial incentive for the industry to make this easy, so it stays hidden. That's actually why I built my entire business around this. My team does nothing else. We eat, sleep, and breathe assumable mortgages. We know the servicers, we know the processors, we know the contract language, and we know how to get these deals closed when other agents can't even figure out where to start. So here's what I'd tell you to do next. If you're buying a home and you want to see if an assumable mortgage could work for your situation, go to assumableguy.com. You can see our current list of assumable properties across Colorado, run the numbers for yourself, and book a free consultation with our team. Even if you're not in Colorado, the information in this video applies everywhere in the country. FHA and VA loans are assumable in every state. I'm going to keep making videos like this, breaking down every part of the assumable mortgage process. So if you found this helpful, subscribe so you don't miss the next one. I'm Ryan Thompson, the Assumable Guy, and I'll see you in the next one.